It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the Money Puzzle Podcast. I am Robert Edgen, and I'll be your guide for the ride for the next few minutes. Each week, we look at a different piece of the money puzzle and practical ways to solve it. Today is episode number 14, and we are talking about passive versus active investing. Joining me today, my business amigo from another placebo is Brian Johnson from the business office up in Denver. Brian, thanks for making the trip down.
You're welcome.
So I'm going to have to work on the intro.
Your intro.
I know. Business pal from another gal. I thought that one was good.
Yeah, I don't know. That's okay.
Business magenta.
From the bigger city.
Business magenta from the other placenta. I don't know. All right. We'll keep working on it. Okay. So today we're talking about passive versus active investing. What's the difference? What the heck are they? Why would you choose one over the other?
Or choose both.
Or you could choose both. That's right. I'm excited to have that conversation. But before we do, I do a lot of reading and research, and I come across different news headlines in my studies. So I thought we would take a quick minute and look at some news. All right, today's news headline comes from Science Daily. Actually, I find a lot of things that pop up in Science Daily.
You do? Yeah, the whole, what was the last one we talked about a week ago?
We talked about witches.
Witches, geez.
That's right. Well, today, let's listen to this headline I came across today. Elevated testosterone causes bull market trading. So... I know. What are they?
Where do you find this?
You already told me. I find some science. So, Brian, not to get too personal, but is your elevated testosterone causing you to invest or trade differently?
I do get excited when I trade individual stocks for myself.
Well, you're not the only one. In fact, so here's what the study says, or the article says. Since the first stock market in Amsterdam in the 17th century, trading floors have been dominated by men. And it turns out that testosterone might be responsible for some of the dramatic bubbles and crashes that we have seen ever since. Let me get to the good part.
Okay.
A study led by researchers from the Ivy Business School, the University of Oxford, and Claremont Graduate Universities for the first time has shown that testosterone directly impacts financial decisions that drives up and destabilizes markets.
Okay, I guess if it was over a boat or a motorcycle or something like that, okay, fine. But yeah, I don't know. Let's keep reading.
All right. They found that testosterone directly increases the size and persistence of stock market bubbles. Testosterone drove these changes in market dynamics by increasing bidding, selling prices, and volume that changed traders' perceptions of a stock's current value, even though the true values were known. So I'll be honest, to me, this is not surprising at all. Because I think about how charged up people get when they're talking about money and investing. Well, now you take those same group of dudes, you throw them on the floor of the New York Stock Exchange where it's so competitive and they're fighting for each other for the best deal. Dude, I totally see this happening.
Yeah, no, I don't see it because the people that are fighting there are taking orders. They're taking orders from investors. They're not out there buying their own shares on the floor of the stock exchange. I don't buy it. I think it's all hyped up. I don't know. All
right, so I'm going to agree with the University of Oxford, and you're going to say that the research. Now, here's the good news.
You can make research or statistics. You can make it say whatever you want. I don't buy it.
Okay, I respect your wrong conclusion, but that's okay. And here's some good news, though, just so you know. They actually did this study in fake trading, in fake trading sessions. So they did not.
There you go.
They took real traders. They kind of replicated, the trading room floor, and they put 140. And then guess what they did? they amped them up on extra testosterone.
You know, oh geez, I'm telling you, it's just like trying to play poker with not real money. What do you do? You go all in when you have nothing.
All right, that could very well be. Here's what I say. It's very interesting study. If you want to read the whole study, the link is in the show notes, so you can take a look at that. But for now, let's go ahead and get with our hot topic of the day. All right, so there are a lot of different ways and styles that you can invest, and there's been a very long-standing argument for years and years and years about what is better, passive investing versus active investing. So first off, let's talk about what is the difference between the two.
Passive investing, think of index funds, right? Index funds, they buy, we'll just use the S&P 500. We always use the S&P 500. So we're just going to say it. You buy the S&P 500 in a mutual fund, Vanguard, Index 500, whatever it is, and it just rides at that level. It never changes.
So a passive investment is really designed to mirror a certain index.
You mirror the index over the long haul, and you don't change it.
You invest in a certain index. Could be the S&P 500 or
the Euro 600, whatever.
The Dow, they're right, whatever the heck it is. But it's basically investing in the stock market or one of the stock markets, because there are many of them.
Right.
You know, it's not trying to see what you can do to beat the markets. It's just saying, if I put my money in the stock market, this is what it's going to do. That is passive
investing. If the S&P 500 does 12%, you expect in that index fund to do 12%.
Okay.
That's right.
Versus active investing.
Yes. Active investing in definition is trying to beat the market.
So, okay. It is taking active steps. It is making trades. It's buying and selling. It's choosing different things with the goal. And this is the definition. We'll talk about what we think about active investing. But the definition is to try to actively outdo or outperform the market.
Outperform the market. So if your benchmark, what you're trying to beat is the S&P 500, again, you're trying to make trades actively, selling one stock for another stock, thinking one's going to be better than the other to try to get a better performance than what the S&P 500 will return. Okay.
Now, the argument forever has been that active investors cannot beat the market, and that hedge fund. In fact, let's talk about this challenge that Warren Buffett threw out to hedge fund managers back in 2007 or 8, one of the two, where he said, "I'm going to give you a 10-year challenge for $1 million. It's going to go to charity. I'm going to put the Index 500, the S&P 500 index, against a hedge fund manager, and who is going to do better." Now, first off, hedge fund managers charge a lot in fees.
They do.
Right? I mean, their fees are all different, but they charge more than pretty much everybody else.
That's why he wears a nicer suit than I do.
I'm not a hedge fund manager. That's just called style. So this challenge was a 10 years, and who could do better, the S&P 500 index or the individual hedge fund manager? So there was one hedge fund manager that accepted the challenge. Nobody else would even take the challenge. But the one who did put 5 different hedge funds up against the S&P 500.
And it was not Warren Buffett himself.
It was not, because Warren Buffett said...
beats the market.
Well, and he said the index will beat you.
Right.
He said passive investing will beat your active investment. And a part of why he was saying that was because of the high fees that hedge funds charge. But even if we take those fees out, let's get to the results. Brian, who won?
Warren Buffett won.
That's right. The S&P 500 index crushed
them by 5%, I think is what it was.
That's right, 5%.
Yep.
So if you would have invested some money in the S&P 500 versus into this hedge fund managers, the hedge fund managers did about 2.2% per year.
Per year, yeah. I was going to qualify that. It wasn't 5% over the 10-year period. It was 5% a year.
So, well, they averaged, that's right, the hedge fund manager averaged 2.2% per year. In reality, if you factor in fees, he made more than that, but that's what the investors saw.
Right.
And the S&P 500 index did
7.1.
So I think 7.7
was it 7? Yeah, it was right up there.
It was about 5% per year more. So Warren Buffett said, "Hey, see, I told you guys, active investing cannot beat the indexes.
Yep.
So, so let's talk about, why, if that's true, why would anyone ever use active investments?
Well,
style, excuse me.
Right. So if you guys listened to our last podcast last week.
2 weeks ago.
2 weeks ago.
Yep.
If you listen to that last one, we talked about beta, right? Beta is when you're doing active investing, we want to try to achieve a nice return based on our goals, correct? Our long-term focus, but reducing our risk below what the market, the S&P 500 risk level. So in fluctuations and volatility, that our investments are a little bit smoother than what the S&P 500 would be. We don't necessarily care about beating the market. What we're trying to do is get a nice return, level out that volatility to meet our clients' goals.
So I totally understood what you said. I'm going to try to simplify a little bit because you said it very well, by the way. But here's what I heard in English. We don't use, or a lot of advisors, not necessarily we, but advisors who are doing active investing, it might be to try to beat the market, but in reality, there are a lot of other reasons. One of the big ones is to try to get similar returns with lower risk. Right. So to take less risk on, and sometimes you can do that through active investing by choosing a combination of safer investments that can give you similar results. So that's one reason to use active investing. I always think of income as another reason to use active investment as a style. So why would you use active investing if you needed income?
Well, when we look at income, we always end up investing in different buckets. We have a cash bucket. We have short-term investments, medium-term investments, long-term. Okay. And so over time, you have to sell some of those investments off. You don't necessarily always want to sell the winners, because what if it's a non-qualified account? Right? We want to sell some of the ones that aren't performing as well to put into our cash bucket to continue to pay out that income.
And a non-qualified account would be an account that's not in your retirement. It's a non-IRA, non-401k, right? It's already been taxed.
There's already been tax money.
Yeah. So you might want to harvest some losses, is what's that called, is what that is called, for some tax purposes. But also, if you are using active investment style, then you might be able to focus on different things that an index passive investment might not focus on, such as dividends.
Yeah, right? Absolutely.
We talked about dividends 2 weeks ago.
2 weeks ago as well. Yeah.
So you could do that. So because that way you could have a constant flow of income and get those from some active dividend investment style.
Yeah, because if you bought the S&P 500 in the passive style, you're buying dividend income stocks, right? You're buying growth stocks. There's a whole bunch of the whole 500, is a little over 500 actually in the index that you're buying, and they're all different. But on the active side, as you said, with the value, maybe we buy only the dividends.
Maybe you can choose. Yeah. So, and then the third reason that that comes to mind as far as why use an active investment style versus a passive is just for some extra diversification.
Sure.
So
absolutely, because when you're dealing with diversification, buy and hold doesn't always work, because then you get out of balance with your goal. If your goal is for value side of the stocks, dividend payers, but you have some growth stocks in there, because we typically will do that, and those growth stocks get a little bit bigger than the value. You want to rebalance that. On the passive side of things, you just let it ride. You don't rebalance it out.
You let it ride. You are passive. Now, all right, so that's the active style. Now, as far as passive investing goes, there are good reasons to invest in passive or have that investment approach as well.
Yep, absolutely.
So when I do, or when I think about passive investing, part of that is if you've got a long time to go and you want to get some growth, right? And you don't want to have some additional fees, or you really are in a buy and hold type environment, right, where you just want to dump money in every month into something. Index is proven to beat most active investment styles.
Absolutely. One of the clients we were talking about earlier this morning, he's 27 years old. He got a long time horizon. I mean, his full retirement age for Social Security is 67. He's got 40 years to go. buy and hold passive index 500 to get started with. Why not? It only makes sense.
Yeah. Now, even though you are, choosing a passive investment style, there are still a lot of good reasons to, work with someone who helps you with that. For example, what index should you use?
Right.
Should you use the S&P 500? Should you use some of, something from Europe? Should you use maybe some smaller cap things? There are a large number of indexes to choose from.
A lot.
Right? So go ahead.
Yeah, sorry. And they're not all created equal. Some of them have a bit higher fees than others. So when you're looking at histories and stuff, that's where we come in, because we have ready access to all those different funds immediately. We can evaluate
based on what you're trying to accomplish and your goals and your tolerance of risk and all of these things. Sure, index investing works great, but you should invest maybe 40% into this index, 20% into this one, and another 40 into this one.
Sure. Right? Yeah, I'll give you a great example. So I just did a financial plan for a family back in, I think it was January, February timeframe. So part of what we do in there, using an advisor, even if you're a passive index investor, is creating that plan to get you from, A, which is like right now,
where you are,
all the way to your retirement age, whenever that, like the one gentleman at 27 years old, 40 years down the road, you still need a roadmap in order to get you where you want to go, to make sure that you're focused on your long-term, your medium, and your short-term goals.
That's right. So you were able to help do that even for someone who's doing a passive investment.
Yeah, and I turned around and I, took on some assets for their contribution for their IRA for the year. And what did I buy? The Index 500.
So yeah, sometimes it makes sense. So here's the deal. Passive investing, active investing, both styles can work. Really what it boils down to is they are tools to use. So which is the right tool for you and which is the right tool for your goals?
Right. And most of the time it's going to be both.
So that's right. Yeah, there's nothing wrong with having some of both.
That's right.
Okay, got it. Brian, anything else that you can think of that we did not bring up for passive versus active? I think we got.
No, don't be afraid of either one. Don't let somebody try to talk you out of the active side of things because of cost. The cost does make a difference in some cases, like we talked about earlier. It does, but when the advice that you receive from us, the planning that you receive, the budgeting, the debt consolidation, not necessarily consolidation, but payoff plans and things like that, that all comes into that fee realm.
Well, you talk about cost. I'll wrap it up with actually another Warren Buffett quote. Okay, price is what you pay, value is what you get. Right. So sometimes you may have to pay, or not sometimes, you pretty much always have to pay more for an active investment style.
You do, but you do to a certain extent, right? Because I turned around and purchased the Index 500. The actual expense ratio in there was very, very, very small. Yeah, right? We talked about bips, right? It was like
2 weeks ago.
Yeah, it was bips. Like 1 point. It was 1 bip. Really, is pretty much what it was. And then my fee on top of it. But I provided the financial plan. I provided the budgeting. I provided the debt payoff plan, which we're still working and we still monitor. And I talk to them every couple of months to make sure. And so we get paid for that advice, not necessarily just for the investments.
So, all right. And really what it kind of boils down to, again, is talk to your professional advisor, talk about what your individual goals, what your plans are, and then put a plan together that uses the appropriate tool to get the job done.
Absolutely.
All right. I think that's it for this week. Thank you for joining me. I always appreciate it. Brian, thank you for coming down.
My pleasure.
If you got any value out of the show, please do us a favor. Share it with friends and family. Also, go and give us a review on whatever podcast app you happen to listen to us on. Go into YouTube, check out our channel there, and give us a review on that. And if you have any questions about your own personal money puzzle, please email us at questions@yourmoneypuzzle.com. And we will get to those. I think that's it for this week. Until next week, be safe, have fun, and go do something to make your money puzzle better. You'll be glad that you did.
registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.